Now let's have this illustration about the long-term note with reasonable interest compounded in. Okay, now what we did earlier on illustration 2 is a simple interest. Long-term siya pero simple interest. Pero itong is illustration number 3 is very compounded siya, hindi na siya simple. Okay, now how do we do this one? On January 1, 2000X 1 issued 3-year 12% and the 1 million note payable in exchange to the piece of land. Principal and interest are due on December 31, 20 X3. Okay, there is no installment. Both interest and the principal are due at once at the end of the promissory note life, which is the maturity date. Okay, here's the analysis. Type of payable and measurement, same as illustration 2. So we have that interest compounded. So we assume again on this stated interest as with the market value, it's a reasonable. So therefore, the face value, we can use that as initial measurement for these notes payable or promissory note. Type of interest, this is compounded. Unlike with the previous again, that is what we call this one, simple interest computation. Okay, so first is how do we make some journal entries in this one? Okay, so since this is a stated interest reasonable, therefore at the initial at the initial date, the initial measurement is at face value. Therefore, the land also at face value. We don't have any independent price for the land, so therefore we are going to follow this notes payable as our valuation for the land at face value. December 31, okay, take note that this particular promissory note will expire or will mature on December 31, 20 X3. Okay, so we have now our first reporting date, which we have to what? We have to compute the interest expense. And remember, both of the principal and the interest will due at the third year. Therefore, at the end of the reporting period or at the end of the first year, there is no payment of the interest, only accrual of this one. So we have here 1 million times 12%. So we have the first one. So simply debit interest and credit interest payable. On the second year, again, there is no payment, debit interest expense, credit interest payable, but the amount is different because we're using compounded. Okay, take note of that. Compounded means to say that the interest before will generate another interest on the next period. Okay, in other words, this 1 million and the new interest on the first year will be now the basis to compute your interest on the second year. That's why the 1 million and the 120,000 were multiplied by 12% to compute the new interest for the second year. So that is 134,400. And that's the same approach when it comes to the third year. Okay. Now, on the third year, the interest expense, the total interest will be all paid. Okay. So how do you compute the total payment of the interest? So of course, on the interest payable, you have to add both the first year and the second year, which is this. So total 254. What about the third year? The third year is computed with again the same approach in the second year. We have to add 1 million the principal, the 120,000 interest on the first year, and the 134.4 interest in the second year. Then multiply it with the 12%. Then we have this 150,528, and that's it. So add both. Well, why we have this account interest expense instead of interest payable? Because that's a new interest for the third year. So therefore, it's not yet accrued as of the last second year. So therefore, it has to be charged directly to the interest expense. Well, that's the approach used by this book. Okay, and get the total of that. This is 404,000. And then the second entry is the payment for the principal. And that's it. Well, the only difference in this one is there is a compounded computed interest, but the rest of the concepts that we applied earlier in illustration 2 are the same. Okay. Now let's move to illustration 4. In illustration 4, this is a non-interest bearing note. Okay, so I want you to remember what again, if what's the rule again, if the note is non-interest bearing, we compute the present value. Okay. So this would be our key now, which is the starting point or the starting value or the initial value of our promissory note or the notes payable as we have here. Let's have this illustration. January 1, 20X1, ABC acquired piece of equipment in exchange for 100,000 cash, a non-interest bearing note of 1 million due on January 20X4. That is exactly 3 years, right? Promissory note. The prevailing interest rate of this type is 12%. This would be, we will use this one as our imputed interest to compute the present value of this promissory note. And please don't ignore that we have a cash in here that is given. Okay. And the problem, we don't find a value for the land, or I mean for the equipment. So therefore, our valuation now will depend upon what's the present value of the note, non-interest bearing note, using that imputed interest and of the cash. Okay, first is we need to compute the present value of the note. So here's the 1 million that is to be matured after 3 years. So we compute the present value factor using the 3 years. So how do we do that? Just multiply the 1 million. I mean, in the present value factor, you can use this one, 1 plus 12%, then raised to 3, then over it by 1. And that's it. That is our due at once. Okay? Yung once lang talaga siya mag-due, wala lang any in between na mga cash flows with regard to the principal. So that's the formula. So if you try to compute that one, okay, para malaman natin kung paano. Okay. So dito sa ating calculator, you can just gawin mo lang dito kung ano yan, manual. 1 divided by 1.12 kasi 1 plus 1 plus 1.12 1 plus 12% is 1.12. Okay? Then again, i-divide mo siya further. That is for the first year. Sorry. Divided by 1.12. That's for the second year. And divided by, again, 1.12. And that is for the third year. And that's exactly how here. Ito yun. So, kita mo? Okay. But there are some problems that the present value factor is given. But if not, of course, at least you know how to compute kung paano yung kinompute yung mga present value factor na yan. Again, this computation is for due at once. Remember that, ha? Due at once. Kasi iba naman yung computation pagdating doon sa installment. Okay. Okay. So ngayon, when we multiply the 1 million with the present value factor, then it will give us the 711,780 pesos. Okay. Now that we have our present value, okay, getting the difference between the 1 million and the present value 711.80, that will give us our 288. Yun na yung ano natin, discount on notes payable. Okay, very important yan. The notes payable account should be always stated at face value, regardless if the present value is different. You just need the contra liability account, discount on notes payable, in order to get into that present value. In the presentation, the notes payable in here for the statement of financial position, the notes payable is 1M. Then you have to less your discount. The discount na magkano yun? 288.20 220. So that would give you on the presentation on the liability of the same, the 711. Okay, 780. So ganun yung mangyari sa presentation. Okay. Anyway, we are going to move on. Okay, ano yun? So ngayon, ang concern natin is magkano yung sa equipment. Ang value ng equipment will follow kung ano yung cash given up at saka yung present value. So that's why ito yung computation. Yun. Okay, now let's try to analyze. There are some notes here provided by the author, the difference between the present value, blah, blah, blah. I think ito na yung sinasabi ko kanina. Okay, now the next procedure step that you need to do, okay, para for the subsequent na mga entries after the initial entries, is kailangan mo magkaroon ng amortization table. Dapat ka talagang marunong paano ang computation or preparation ng amortization table. At first, it has to start at the present value. 711, 780. Okay? I hope that you get that. Okay. Now, second is this present value is to be multiplied with this one, 85,414. Okay? Ang effect nito, ito na yung interest expense natin. The interest expense, pagdating sa mga may discount o note payable, idadagdag yan dito sa beginning. So, itong 711, 780 plus the interest na 85,414, it will give us to this amount. Yon. So, try natin. Okay. Try natin na. 711,780 plus 85,414. Yon. 797,194. And do the same process on the next tier. Okay? So that's how it works until such time that you will get into the 1 million ending balance. Okay? Okay. Now, once that you completed your amortization table, again, you should know how to do that. Just follow what I did. Pwede ka nang mag-prepare ngayon ng mga journal entries, okay, subsequent to the initial measurement. Okay, on the first year, kailangan mo mag-amortize talaga every reporting date and every interest date. Sometimes yung interest date ay mag-fall siya other than the reporting date. Let's say every 6 months itong payment ng sorry. For this type of notes payable non-interest bearing note, this is due at once. So, ang mangyari dito, ang amortization would fall exactly on every year. So, nagkataon lang na ito ay yung kanyang issuance ay nangyari on January 1, 20X1. Therefore, ang kanyang first na amortization would fall at the end of its first year. So that's why walang kaso. Pero kung halimbawa, yung kanyang issuance ay nagkataon other than January, let's say February, March, or let's say March 1 or April 1, the interest payment, the yearly amortization does not always fall on the reporting or does not fall on the reporting date. So therefore, if that is the case, then you have to make some prorata or prorate on the amortization of this, okay, for 9 months, if that is April. Okay, so we don't have this illustration is so simple that just to show to you, it's like a demonstration of how it works. Pero mamaya, kung mayroon tayong mga other problems, I can show it. So anyway, pagpatuloy natin. Interest expense, una yon. Lagay mo lang interest expense, discount notes payable. Ganun din ang gagawin mo sa next, then sa next, until there's a fully payment of the obligation or on the notes payable. Ganun lang. Okay? Ang crucial lang dito, you have to know the amounts. And the amounts should follow to this amortization table. Ganun lang. Kagaan. Diba? Madali lang. So, alamin mo lang kung paano mag-compute ng present value, that's your beginning. And then, alamin mo kung paano mag-prepare ng amortization table. Then, for the amortization table, you will know simple as fast as that if your amortization table is correct. And that begins at the computation of the present value. And that's how it is. Okay? Hope that you get. So, on the next illustration 5, we are going to compute the non-interest bearing note, but at this time, this is installment. Okay? More complicated. Thank you.